Look at the ticker on your screen. You see silver priced in the low 30s, and you think you're looking at the value of the most conductive element on Earth. You aren't. You are looking at a ghost, a paper derivative that has fundamentally decoupled from the physical reality of the global vaults. As of late 2024, a silent alarm has begun ringing in the halls of Beijing. The Chinese Ministry of Commerce has signaled an aggressive tightening of strategic metal exports. And while the mainstream media tracks gallium and germanium, industry insiders are focused on the 2026 ghost. This is the projected inflection point where China AS, domestic mandates for HJT solar cells, and AI thermal interface materials are expected to exceed their current supply, potentially turning the world's largest refiner into a closed loop. This isn't theory, it's a pattern. Historical data from the 2010 rare earths crisis proves that when China moves toward export licensing, the Western spot price quickly becomes a fiction. Currently, the Shanghai Gold Exchange is maintaining a consistent physical premium over London and New York, suggesting a massive Shanghai Siphon is already draining Western liquidity. The trap is the byproduct paradox. Because approximately 70% of silver is produced as a secondary result of mining copper, lead, and zinc, the supply cannot simply turn on because silver prices spike. Data from the World Silver Survey indicates a multi-year structural deficit that is now colliding with a decade-long discovery to production timeline for new mines. We are approaching an invisible wall where the paper market's ability to settle in cash will no longer satisfy the industrial world, as need for physical atoms. The ticking you hear isn't market volatility. It's the sound of the 2026 clock reaching zero. This analysis is for educational and informational purposes only. The silver market is highly volatile and influenced by complex geopolitical factors. This is not financial advice. Always perform your own due diligence or consult a certified financial advisor before making investment decisions. To understand why the 2026 export licenses are a potential death knell for the current silver spot price, we have to look back at the last time Beijing pulled this specific lever. In September 2010, the global manufacturing sector learned a painful lesson in resource weaponization. Following a maritime dispute near the Senkaku Islands, China abruptly halted shipments of rare earth elements to Japan. Within months, the price of neodymium and dysprosium didn't just rise, they went vertical, with some elements seeing 2,000% increases. This wasn't a market fluctuation, it was a demonstration of a new kind of economic warfare. The rare earths crisis proved that when you control the refining capacity and the export permits, the global market price becomes whatever you say it is. Fast forward to the present day, and analysts suggest we are seeing the exact same blueprint being applied to the silver market. This is the 2026 ghost. The strategy begins with what we call regulatory creep. As of late 2023 and throughout 2024, the Chinese Ministry of Commerce, or MOFCOM, has been systematically tightening the screws on strategic metals. First, it was gallium and germanium, critical for semiconductors. Then came graphite. Most recently, in late 2024, Beijing enacted export restrictions on antimony, a key component in everything from flame retardants to ammunition and solar glass. Each of these moves followed the same pattern: the announcement of a licensing requirement for national security reasons. On paper, it looks like administrative housekeeping. In practice, it's a kill switch. History shows that once these licenses are in place, the flow of physical metal to the West becomes a trickle. This brings us to the 2026 inflection point. Industry reports indicate that China's domestic demand for silver is currently on a trajectory to consume nearly its entire internal production and refined imports by 2026. This is driven by the industrial trifecta: the rapid scaling of HJT solar cells, which require significantly higher silver loading than previous generations, and the explosion of AI hardware. In the high-stakes world of AI data centers, silver is no longer an optional luxury. It is the primary ingredient in high-end thermal interface materials, the TIMs, that allow the next generation of GPUs to operate without melting under their own heat signatures. The danger for the Western investor lies in the spot price illusion. During the 2010 rare earths squeeze, the prices on Western exchanges lagged behind the reality on the ground until it was too late to react. We are seeing early symptoms of this today. Data from the Shanghai Gold Exchange consistently shows a physical premium over London and New York. This Shanghai Siphon suggests that while the West trades paper contracts, the East is quietly hoarding the physical atoms. This is where the byproduct paradox turns the rare earth's blueprint into a trap. Unlike the rare earths of 2010, which could be mined as primary targets, approximately 70% of the world's silver is produced as a secondary result of mining copper, lead, and zinc. This means that even if the silver price doubles or triples due to a Chinese export ban, supply cannot simply turn on. A copper mine won't increase its multi-billion-dollar production schedule just because the silver byproduct is more expensive. Based on current USGS mineral commodity summaries and the decade-long discovery to production timeline for new primary silver mines, the West has no quick response mechanism. If Beijing moves to a full closed-loop licensing system for silver by 2026, the global market will hit a wall that hasn't been seen in our lifetime. The 2010 crisis was the dress rehearsal. The 2026 projection is the main event. We are watching history repeat itself. But this time, the metal in question is the very backbone of the digital and green revolutions. The ticking you hear is the sound of the 2026 clock reaching zero, and as history proves, Beijing rarely misses its cue. To understand why those cues are so well timed, we have to look past the geopolitical theater and into the microscopic architecture of the modern world. The 2026 export licenses are the final piece of a puzzle known as the industrial trifecta. This is the convergence of three massive technological shifts, AI, solar, and EVs, that have one common, irreducible requirement: silver atoms. For decades, the narrative was that technology would eventually thrift silver out of existence. We were told that engineers would find cheaper alternatives like copper or aluminum, but as of late 2024, we are hitting a thermal ceiling, and where the laws of physics are overriding the laws of economics. Take the AI revolution. Most viewers think of AI as lines of code in the cloud, but on the ground, AI is a thermal crisis. As we track the rollout of next-generation GPU architectures, such as NVIDIA's Blackwell chips, we are seeing power draws exceeding 1,000 watts per processor. This isn't just a power drain, it's a heat management nightmare. To prevent these multi-thousand-dollar chips from self-destructing, the industry relies on thermal interface materials, or TIMs. According to current technical specifications, high-performance silver-sintered TIMs are the only materials capable of moving heat fast enough to keep these systems stable. Silver boasts a thermal conductivity of 429 watts per meter, Kelvin, the highest of any element. While copper is a distant second, it oxidizes and degrades under the extreme thermal cycling found in AI data centers. Silver does not. Industry reports indicate that as AI hardware moves toward liquid cooling and higher density racks, the demand for high-purity silver paste is no longer a marginal cost. It is a mission-critical bottleneck. But the AI heatsink is only the first pillar. The second is the global pivot to HJT, or heterojunction technology solar cells. For years, the solar industry used PERC cells, which were relatively light on silver. However, data from the 2024 World Silver Survey and Bloomberg NEAF projections confirm that the industry is currently transitioning to HJT and TOPCon cells to squeeze more efficiency out of every ray of sunlight. The technical reality is sobering. HJT cells require significantly higher silver loading than the tech they are replacing. While an older cell might have required 10 milligrams of silver per watt, HJT cells can require nearly double that. This isn't a choice, it's a requirement of the low-temperature manufacturing process that makes HJT cells so efficient. You cannot simply swap the silver for a cheaper metal without the entire panel efficiency collapsing. As China, which controls over 80% of global solar cell manufacturing mandates, this shift, the 2026 timeline for export licensing, begins to look like a strategic calculation to secure their own green energy future at the expense of the global market. The third pillar is the electrification of transport. As of the Q3 2024 refresh of automotive supply chain data, the shift toward 800-volt EV architectures is accelerating. These high-voltage systems require vastly more silver for power electronics, sensors, and fast-charging infrastructure than the 400-volt systems of 5 years ago. An average electric vehicle now contains between 25 and 50 grams of silver, roughly double that of an internal combustion engine vehicle. This brings us back to the byproduct paradox. This is the structural flaw in the silver market that analysts suggest will lead to the 2026 crunch. because roughly 70% of silver is produced as a secondary byproduct of copper, lead, and zinc mining. The supply is what economists call inelastic. If the price of silver triples because Nvidia and Tesla are scrambling for physical delivery, a copper mine in the Andes isn't going to double its production. They can't. They are mining for copper. Based on current USGS mineral commodity summaries, the discovery to production timeline for a new primary silver mine is now averaging 12 to 15 years. This means the supply for 2026 is already baked in. There is no emergency valve to turn on. When you combine the industrial trifecta with the fact that supply cannot react to price, the 2026 ghost becomes a physical certainty. Beijing isn't just restricting a metal, they are restricting the thermal bridge of AI and the nervous system of the green transition. For the Western investor, the realization is coming too late. The spot price is a measure of sentiment, but the 2026 licenses are a measure of survival. The Shanghai Siphon is already moving, and once the industrial trifecta fully consumes the available float, the paper house of cards won't just fold, it will evaporate. To understand why the silver market is heading toward a structural dead end, we have to dismantle the most common myth in commodities, the belief that higher prices will inevitably trigger an immediate flood of new supply. In most industries, if the price of a product doubles, manufacturers simply add a third shift or open a new factory. But silver is not a standard commodity. It is a geological hitchhiker. According to the World Silver Survey 2024, approximately 72% of the world silver supply is produced as a secondary byproduct of base metal mining, specifically copper, lead, and zinc. This creates what economists call absolute supply inelasticity. If the price of silver were to moonshot to $100 an ounce tomorrow, it would not change the production schedule of a multi-billion-dollar copper mine in the Chilean Andes by a single gram. For a copper major, silver is a rounding error on the balance sheet. They are not going to accelerate a 5-year mine plan or spend billions on new infrastructure just to capture more of a secondary metal, no matter how high the price spikes. This is the byproduct trap. As of late 2024, the base metal sector is facing its own systemic crisis. Data from the USGS indicates that global zinc production has stagnated as aging mines hit lower ore grades, and rising energy costs force smelter shutdowns. Because silver is tied to these base metals, when a zinc mine in Europe or Australia closes, the silver supply associated with it vanishes instantly, regardless of silver's market value. We are in a bizarre reality where the price of silver could be hitting record highs, while the actual production of silver is falling because the copper and zinc markets are struggling. Then there's the insurmountable wall of capex lag. Even if a mining company identified a massive primary silver deposit today, they are fighting a timeline that the modern financial world is not prepared for. Industry reports indicate that the average discovery to production cycle for a new Tier 1 mining asset has stretched to between 12 and 15 years. This delay is driven by a gauntlet of tightening ESG mandates, permitting hurdles in the sheer technical complexity of modern deep vein mining. Analysts suggest we are currently living through the lost decade of exploration. Between 2012 and 2022, global capital expenditure in the mining sector plummeted as investors favored tech stocks over old economy commodities. This means the silver we will need for the 2026 AI and solar boom had to be discovered and funded back in 2011. The data shows it simply wasn't in T. This creates a terrifying reality for Western manufacturers. As the industrial trifecta ramps up demand, the mining valve is essentially rusted shut. We cannot mine our way out of the projected 2026 deficit because the infrastructure needed to bridge that gap does not exist yet. Furthermore, as copper miners are forced to dig deeper for lower grade ore to meet EV demand, the silver to copper ratio in those ores is often declining. The conclusion is inescapable. The market is operating on a just-in-time inventory model, while geological reality is on a decade-at-a-time lead cycle. If Beijing moves to restrict exports as the 2026 licenses suggest, there is no plan B waiting in the ground. The silver required for the next generation of chips and energy isn't just expensive, it hasn't been dug up yet, and at current capex rates, it won't be for a long time. The trap is set, and the 2026 clock is the only thing moving faster than the supply-side lag. While the geological byproduct trap explains why new silver is in T coming out of the ground, The Shanghai Siphon explains where the existing silver is going. To understand the 2026 deadline, we must look at a growing fracture in the global financial system, a regional fragmentation that is effectively decoupling the price of silver in the West from its value in the East. For decades, global price discovery for silver has been dominated by the paper price on the London Bullion Market Association, LBMA, and the New York COMEX. These markets operate primarily on futures contracts, promises to deliver silver rather than the physical exchange of metal. However, as of late 2024, a massive arbitrage gap has opened between these Western exchanges and the Shanghai Gold Exchange, SGE. Data tracking the SGE premiums throughout 2024 shows a persistent and widening divergence. While the spot price in New York might be trading at one level, physical silver in Shanghai is frequently trading at a premium of 6%, 10%, or even 15% higher. This isn't just a statistical anomaly, it is a giant geopolitical vacuum. In the world of high-frequency trading, this is a risk-free arbitrage. Traders buy physical silver at the lower paper price in London or New York, pay the shipping and insurance costs to fly it to China, and sell it on the Shanghai Exchange for an immediate profit. This is the Shanghai Siphon, and the results are visible in the vault data. According to the Q3 2024 COMEX inventory refresh, we are witnessing a systematic drain of registered silver, the metal specifically designated and available for delivery to satisfy futures contracts. Analysts suggest that the ratio of paper silver to physical silver on the COMEX has reached levels that make the market increasingly fragile. If even a small fraction of paper contract holders demanded physical delivery simultaneously, the exchange would face a liquidity crisis. At the same time, LBMA vault totals in London have hit multi-year lows. The metal isn't vanishing into thin air, it is moving from west to east. This shift represents a transition from financialized silver, metal that sits in a vault and serves as a backdrop for speculative trading, to industrialized silver, metal that enters the Chinese ecosystem to be consumed by the industrial trifecta of AI, solar, and EVs. This is where the 2026 export licenses become the ultimate strategic weapon. By 2026, Beijing will have spent years using the SGE premium to suck the float, the world's mobile silver supply, into its domestic vaults. Once the 2026 export restrictions fully take effect, that silver is effectively locked behind a one-way valve. It can enter China, but it cannot leave. Industry reports indicate that China is no longer content to be a mere manufacturer. They are moving to become the global price setter for strategic materials. By draining Western vaults today, they are ensuring that when the industrial trifecta hits its peak demand in 2026, the West will have to compete for a dwindling supply of silver that is no longer held in London or New York, but in Shanghai. The paper price you see on your screen is losing its global relevance because it no longer reflects the cost of obtaining the physical atoms. We are entering a great regional fragmentation where two prices for silver exist, a lower theoretical price in the West based on paper derivatives, and a higher physical price in the East based on industrial necessity. As of late 2024, the Shanghai Siphon is accelerating. Every ounce that leaves a COMEX vault for the East is an ounce that is likely never coming back. For the Western investor or manufacturer, the 2026 licensing deadline is the sound of the vault door locking from the inside. When the West finally realizes that the paper contracts cannot be settled in physical metal, the paper house of cards will face its reckoning. And the true value of silver will be dictated not by traders in Manhattan, but by the industrial requirements of the East. The siphon is active, the vaults are emptying, and the 2026 clock is ticking toward a total structural decoupling. This brings us to the most volatile fault line in the global economy, the decoupling of physical reality from the paper house of cards. To the average observer, the price of silver is simply what they see on a ticker. But for the institutional paper traders on the COMEX and LBMA, silver isn't a metal, it's a high-leverage financial instrument. As of late 2024, the structural integrity of this system is being tested by a mathematical impossibility. The COMEX operates on what is effectively a fractional reserve basis. According to current exchange data, there is a massive disparity between open interest, the total number of outstanding contracts, and registered silver, which is the actual physical metal sitting in vaults specifically designated for delivery. While the ratio fluctuates daily, industry reports have observed periods where paper claims outweigh physical metal by a factor of 100 to 1 or more. This means that for every ounce of silver available to be shipped out of a warehouse, there are potentially 100 paper promises claiming ownership of that same ounce. Analysts suggest this system works efficiently in a normal market where 99% of traders settle in cash, but we are no longer in a normal market. Historical data from the Silver Institute indicates that industrial demand is now outstripping mine supply for the fourth consecutive year. As the industrial trifecta of AI and solar intensifies toward 2026, those paper promises are beginning to look like IOUs written on a napkin during a hurricane. Consider the impact of a minor delivery demand spike. Calculations based on current inventory levels suggest that if just 1% or 2% of paper contract holders suddenly ignored the cash settlement and demanded their physical bars, the COMEX registered inventory could potentially be exhausted. This is the mathematical trap. The paper traders have sold silver they do not have to buyers who increasingly need the physical atoms for high-tech manufacturing. As of the Q3 2024 COMEX inventory refresh, we are seeing the results of this pressure. The them in this scenario, the large bullion banks and short sellers, are trapped in a game of musical chairs where the music is slowing down, and China has already moved the chairs to Shanghai. When the 2026 export licensing wall goes up, the West will be left holding paper contracts that cannot be redeemed for physical metal, because that metal has already been siphoned east. This isn't a mere market fluctuation, it is a systemic fragility. For those tracking these metrics, the key question isn't whether silver is expensive, but whether the paper price bears any relation to the physical cost of acquisition. This structural divergence suggests that the paper house of cards is facing a reckoning where the true value of silver is finally set by those who hold the metal, not those who trade the derivatives. In a world of paper promises, physical delivery is the only truth that remains.